Welcome to Target Professional Consults. Today we are going to look at one of the standards, the financial reporting standard, very popular one and most relevant or important one called IAS 16, Property, Plant and Equipment. So IAS 16, sorry, let me put it up so that we can get enough space. Good. Good. Yep. IAS 16. So it talks about property plants, and what equipment. Normally shortcut it, call it PPE. But just be careful that in COVID time, if you mention PPE, it will tell you it is what? Personal protective equipment. So be careful about the shortcuts. Kindly write it in full. Yes, good. So that's what we are going to look at in this video. This is the first chapter, the chapter 1. We look at just the initial section, and then the chapter 2 look at the last section because this is a very long standard. So we have a lot of issues to cover. So we break into 2. Good. Now let's go straight. Now if you pick each and every standard, there are about 5 items you should know about that standard. 5, then you are done. 5 standards about 5 issues about each standard. So issue number 1 will be the objective and the scope of that standard. Scope talks about the coverage. Does it cover all? Then 2, you have to look at some definition or basic definition of some term. So basic definition enshrined in that standard. So basic definitions enshrined in what? The standard. So if I what PPE, some terms mentioned in the standard. So basic definition of what? Definition, we can make it of some terms. Good. Then the third item, very important, pretty important, that you need to get it. That is the recognition, where most of your question will be centered on recognition. And then measurement, 5 items. Measurements, most of your exam questions are on these 2. The rest, no. Then the last one is disclosure. Disclosure requirement. Issues that you have to tell the users about RPP. So basically, if you are okay with these 5 items, that's all. Now the most important one is the recognition and the measurement. So make sure that when we get there, you are fine with these 2. Because that drive most of the standards, recognition and measurement. For teaching purposes, I'll go through systematic order. I'll start from the objective and then the scope and run down to the disclosure requirements. Good. So in this video, we will run through up to the initial measurements, and then the next video, we will look at the subsequent measurements. Good. Now let's go straight to the objective and scope of IAS 16. Now, once you know the name of that standard, you should know the objective, because the objective of every standard is to prescribe the correct accounting treatment of that standard. So if this IAS 16 is talking about PP or property, plant and equipment, then the objective of IAS 16 will be to prescribe the correct accounting treatment of property, plant and equipment. Have you get it? Good. So that's the objective. So I'll take this section off Then come to it. So the objective is to prescribe the correct accounting treatment of property, plant, and equipment. Or you can also state that to deal with what PPs in our financial statement, our books. So that's the main objective of the PP of the IAS 16. Good. But before that, this is the collection. This standard from the collection of tangible non-current assets. Tangible non-current assets. Good. Tangible non-current assets. They are quality standards. We will look at them. PPE or the IAS 16 is the first set that we normally consider. So that is it. In fact, we will consider IAS 16, 40, 23. These are the tangible non-current assets. Standard that affect the tangible non-current assets. You can also consider the IFRS what? 16, that's leases. Leases also affects. And then grants, government grants, all of this. Good. But these are the main. Now let's go straight. Sorry. Now the scope. Scope, it covers all PPs except those covered in other standards. In fact, from henceforth in our financial reporting, when I mention PPE, I'm referring to property, plant, and equipment. How we get it? Good. So the scope of IAS 16 that it covers all property, plant, and equipment except those covered in other standards. So specifically, we are going to list some of the PPEs that IAS 16 requirement does not cover. Good. So it covers all PPEs except the following. So it covers all except what? Except the following. So it means that specifically the following items, the requirement of IAS 16 does not cover the following items. Item number 1, biological assets. Biological assets. Biological assets that we use to produce agriculture products. Biological assets that we use to produce what? Agriculture products. With the exception of what? Biological bearer plant or biological bearer what? Assets. So except, wow. So here there's an issue. Good. Except biological bearer plants. Now, in fact, let me make it assets. If I write plants, I've limited myself. Good. So it means that this is what PPE. That's what it tells us. This is PPE. This form part of what PPE. However, biological assets, that is, biological assets do not form part of what PPE, with the exception of one specific biological asset, which is what? Biological bearer plants or biological bearer assets. Please be with us, then we will explain. In fact, we will go into detail what are what biological bearer plants. Now let's move on to IAS system does not apply. We are looking at the exceptions. Does not apply. Does not apply to mineral rights, and what? Mineral reserves. So mineral reserves. Good. So mineral reserves. Great. So if you have consumption in gold, oil, bauxite, even though it may form part of PP, IAS 16 does not what covers it. So mineral reserves. Maybe you store a lot of your wealth, you stored it in gold. So most of your assets are in gold, even though that gold that you've acquired, you are not going to probably dispose it off just for future purposes. It does not fall within the scope of what IA 16. Sorry, that section is not coming. So, but it's mineral reserve. Example include what gold, oil, gas, then the other. The third one is any PP held for what? Held for sale, or PPs classify as what? Held for sale. So PP is classified. How that section is coming. Classify as what? Held for sale. So held for, but it's not coming. But PP classify as what? Held for sale. Classify as held for sale. That is another standard governs. So that's why this requirement might not hold. So classify as what? Held for sale. That's what IFRS what? 5. All of these, they have specific standard that governs them. This is IAS 41, biological assets. Good. Biological assets. That is it. So now, in short, the following are not PPE. That is it. These are not PPE. So they shouldn't form part of your PPE. These are not PPE. One, biological asset is not PPE. However, biological burial plants or burial assets are what? They are PPE. Good. Mineral rights, they are not what? PPE or mineral reserve. Or any PPE that you are selling it, if determine or if classified as what? Held for sale, they are not what? PPE. So that is the scope. Great. So now we are done with what? The scope of IA 16. So now let me take my time and talk about biological assets. Good. In fact, we normally call it or a critical example that denotes the burial plants. Burial plants. So that is now let's look at it. Why burial plant is what? It's a PP, but the other biological assets are not what? PP. So that is it. We'll look at PP, what it is, property, plant, and equipment, the definition, then you'll be fine. Good. You'll be fine. Now let's so burial plants. Fact, I use three features to distinguish or to explain the burial plants and then the other plant that we have. But burial plants are PP, they form part of PP. One, feature number one, they are what? Living plants. Living plant. Living plant. That's first feature. That are used, second feature, that are used to produce and supply agriculture produce. How do we get it? Agricultural produce. So they are living plants that are used to produce. They are used to produce and supply. I like that. Produce and what? Supply. Agriculture produce or agriculture what? Products. So agricultural produce. Produce. How do you get it? Then lastly, their produce lasts for more than one period. Their produce lasts for what? More than one period. Their produce lasts for more than one period. or they are expected to bear produce for more than one period. Okay, so I think we take the second one, and then expected. So it's expected. So it's expected to. So expected to bear produce for more than what? One accounting period. One period. So I hope you get it. Bear produce for more than one period. Bear produce for more than one period. So expected to bear produce for more than one period. This is what bearer plants. Good. For their PPE. Example. Let's do the example. Example. I like the example. So cocoa. So cocoa. Examples: cocoa, oil palm. Good. Then what again? Factory crops. Coconuts. Also talk about grapes. Yes. And then many more. Good. Can talk about oil palm. Then you can also talk about the grapevine or rubber tree. Have you seen rubber tree? Good. All of them are examples of what? Bearer plants. Good. So this is the definition for bearer plants. And it's the same for that of bearer biological assets. Bearer biological what? Assets. So when they ask you what are bearer biological assets, you can tell the examiner that they are assets that type of living plant that produce and supply what agricultural produce expected to bear produce for more than what one period, more than one period. Then that is it. Good. This is an example of what PP. Now let's move on the game. Now we are done with the scope and what and the objective. So now let's go to the next one. Basic definition of what some terms. So let's go and then pick some few terms mentioned in the standard. So now let me list the terms down for you. Great. So now let's look at the terms. The first term is to define the PPE himself. So that's the property plant. So let's go to terms. Terms stated. So terms stated one. The property plants and what equipment. Equipment. Good. Property plant and equipment. So that's the first term we are going to look at. So you should know the definition. Now, property, plant, and equipment, that one also, the definition is very long. In fact, IAS 16 have a large number of terms being defined in there. So we are going to look at the terms. So it means that at the end of this chapter, you should be able to come out with the meaning or the definition of these terms, and then you are fine. First term, property, plant, and equipment. So property, plant, and what? Equipment. Now I use the features to define the PP. So first, they are property or they are tangible non-current assets. They are what? Tangible. Wow, I like the term. Tangible non-current assets. So PPs are what? Tangible non-current assets. That's the first feature. Feature number two, acquired with an intention not for resale. So acquired with an idea, not for resale. So acquired with an intention. So acquired with an intention not for resale. Now the issue is this. Why should you acquire a non-current asset, or why do you acquire assets that you design or hold them not for sale, or you acquired assets and you're not going to sell it? What would be the reason? Good. Now let's look at this. In fact, PPs, they are what? Tangible, let me call it assets. Good. So tangible assets. The asset that you acquire not for resale. When you say tangible, in fact, we want the non-current, like what I wrote first. We want the non-current section. The current assets example is what? Inventory. Inventory is also what? Tangible. Good. But what we are looking after is the one that you acquired, not for what? Not for sale. So if you acquire any assets with the idea or with the intention not for what? For resale, but for what? So the reason is here. But for use in production, use in the production of what? Goods and services. So for production of goods and services. Goods, goods and services. So if you acquire any assets that you are not going to sell that asset, but that asset must be tangible, meaning it must have what? A physical character. Yes, it must exist. Good. Or rental purposes. Oh yes, you can buy assets that you're not going to sell it, but you're going to what? Use it to conduct. Let's take example like a taxi, a vehicle for rental purpose, building any furnitures, office chairs for rental. They are what? PPE. Good. Then the last feature is that they last for more than what? One accounting period. That's the last feature. Or expected to be used during more than one period. Or expected to last for more than one accounting period. And then expected to be used for more than one accounting period. Expected to be used, expected to be used for more than one period. Good. So that's PP. We are done defining PP. So, oh, sorry, link up. That side did not appear. Sorry, everything's fine. Good. More than one period. So that is property, plant, and equipment. So that's the definition. So when I ask you to define property, plant, and equipment, this is what we're asking from you. Tangible assets acquired with an intention of not for resale, but to use in production of goods and services, or for rental purposes that are used for more than one accounting period. We are done. Good. Now let's move on to the next term. The next term is very interesting, powerful, and that we are going to meet cost. We're going to meet the term called cost in this standard. So let's look at cost. For the remaining one, let me list them down and then we try and then explain them. Then we'll be fine. So cost. So the second term will be cost. You understand cost. Third term is the residual value. Residual value. The fourth term in this entity specific value. Specific value. In fact, don't even worry yourself. It is the same as what? Value in use. Good. So if you are familiar with value in use, you will see entity specific value in use. Then we will consider what? Fair value. In fact, I like that term. The value which is what? Fair. The value which is fair. So that's the fair value. Then the sixth one will be carrying amount. Carrying amount. Normally I call it CA. Good. Then item 7 is impairment loss. Impairment loss. Just that we are going to consider that under IAS 16, so I'll not talk much about it. Impairment loss. Then we move on to the item number 8. If you look at it before, so I'll just write them here. Bearer plants. Bearer plants. Good. Sorry, you can't see that pattern. I'll adjust the board for you. Okay, it's coming. So that's bearer plants. So these are the terms that we have to familiar ourselves with in these standards. So before we finish these standards, we are going to meet all these terms. In fact, the popular one is the 16, the property, plant, and equipment. So now let's consider cost. Cost. We mentioned cost. Now, when you talk about cost, we are referring to the amount of cash or cash equivalent paid or fair value of other consideration given to acquire an asset. So that's the cost. So if you want to acquire certain property, I'll not give example. I'll give. If you want to acquire certain property, plant and equipment, how much will you transfer or lose in order to gain that property? That is the cost of that property. Now, examples of property, plant and equipment, let me list them here. So examples include land and building. 1, 2, plant and machinery. So plant and, I can say plant and machinery or plant and equipment. Good. 3, furniture and fittings. And fittings. 5, computer. Computer. Motor vehicle. Vehicles. All these are what? Property, plant, equipment. Please, it must satisfy the definition. We said they are what? Tangible assets. All these are tangible assets. Good. And then acquired, not for resale. It does not mean that if you have a land, all land are what? PP, all buildings are PP, all plants are PP. No, not at all. It depends on the idea behind its acquisition. If you acquire them for use, they are PP. If you acquire them for sale, they are not PP. They are what? Inventory. IS2. Good. So that is it. So the real estate developers, the land that is ready or the building that is ready for sale, that's not what PP. However, the land or the building, office building, the one that they are using to run the administrative activities, that is what PP, because that building is not for sale. Good. Or that land is not for sale. Now the cost is how much you incur to what? Probably obtain this PP, but the definition is cash or cash equivalent paid or fair value transfer, fair value of other consideration transfer. So the cost is made up of one, either cash or cash equivalent. Cash what? Equivalent. Let me write it here small. Cash equivalent. Now sometimes you do not pay cash, you transfer assets. Or sometimes you transfer other swapping, right? Yes. You have a vehicle there, and then you exchange with the land or a building, or you have a good there, you exchange that good for what? For that building or land good. So that's the cash equivalent. Or fair value of other consideration. Like the example that I gave, the gold, the car that you exchange for a building. What's the fair value of that gold? What's the market price of the gold? Fair value. Why are you? You've mentioned fair value here. So that is it. Okay, now let's move on to the game. So that's cost. Basically, how much you acquire the asset for. It normally depends on what you sacrifice in order to acquire that asset. So you have to sacrifice, let's say, 10,000 cedis. That is the cost. But we look at it into detail. Yes, right after here, look at it into detail. Now let's look at residual value. What is residual value? Residual what? Value is the net amount which the entity expects to obtain for an asset at the end of what? Its useful life, after deducting expected cost of what? Disposal. Basically, after we have used the assets, can we dispose it off or sell it off for a scrap value? Normally we call it scrap value. Scrap. Good. Scrap value. So it is the net amount. So maybe if the asset will last for 5 years, at the end of the 5th year, how much can we obtain from that asset? Just an estimate. Good. And it must be net of what? Selling cost. So the disposal value is net of what? Selling cost. Probably after the end of the asset's useful life, you have to change certain things or rebrand it or remove some certain parts, carry it to the suppliers or the customers' premises at additional cost. It must be deducted. That's all. Then entities specific value. That is the present value, PV. Present value of the future cash flows that you are going to generate from this asset. If you use this asset to produce, what are the cash flows or what are the benefits that you are going to generate from this asset? Its value today, that is the value in use, or the entity specific what? Value. How we get it? Great. So it is the present value of the cash flows an entity expect to arise from the continuing use of an asset from its disposal at the end of the useful life. Good. Now let's go to fair value. My best friend, fair value. The value which is what? Fair to everybody. The value must be fair to everybody, must be transparent. Good. So fair value. Fair value. Now the fair value is defined by fair value measurement. That's IFRS what? IFRS 13, fair value measurement. Defines fair value as what? Is a price. Wow, so fair value is what? Is a price that will be received to sell an asset. So any price that you are willing, so that I say fair, that price must be fair, that value must be fair. So if you have an asset here like this, so the amount that you be willing or to receive for this. Okay, now let's continue the definition. So it's the price that will be received to sell an asset or pay to transfer a liability. So it means that fair value does not move in line with asset. It's also move with what? In fact, everything on this set have a fair value except for items that do not have what? Active market. So liabilities also have fair value. Yes, assets also have fair value. So fair value is referred to what? It's a price. Great. So fair value refers to what? Price that will be received to sell an asset or paid to transfer a liability. in an orderly transaction between market participants at the measurement date. That is the definition for fair value. Let me repeat. It's the price that will be received to sell an asset or paid to transfer a liability. Paid to transfer a liability in an orderly transaction between market participants. Yes, at the measurement or date between market participants at the measurement date. That is it. Now, market people, that is the market participants. That means buyer and seller do not know themselves. They are unrelated. That is arm's length transaction. For instance, if you are selling PP to your brother or a sister company or a subsidiary company, sometimes, in most cases, not at fair value. That means, oh, brother, thank you, sister, thank you. Oh, it's my brother, so instead of 1,000 Ghana, just bring 200 cities. That does not mean that when you go, they will sell to you at 200 Ghana. No, that's not a fair value. Great. So this is the term that we are going to, in fact, use most in financial reporting. Fair value. Good. Now let's go to carrying amount. Then we are done. The rest will be covered. So carrying amount. In fact, it's an amount at which an asset is recognized or recorded in the financial statement or the financial position after deducting two items. So in short, it's an amount at which the assets will be recorded in the financial position, the balance sheet, or the financial statement after deducting one, depreciation, two, impairment. Good. So carried amount is nothing by amount that we can record for a particular asset after deducting depreciation and impairment from cost. From where? From the cost of the asset. From the cost of the asset. So let me take this section off, okay? From the cost. So in short, carrying amount simple means cost of the asset. Where can I record that? Okay, I can probably that one here because we're done explaining this. So carrying amount, in short, CA, chartered accountant, come again, is equal to the cost of the assets less what? Depreciation less what? Impairment loss. Good, less impairment. So that's carrying amount. Now let's move on. Now with the impairment loss, we will talk about this when we go to impairment. There's a full standard on impairment, so I won't talk about it here, but you should know that it's also here because we've mentioned it's impairment loss. Depreciation I'll explain subsequently. Buyer plant, we've explained it, so now we are done. We are done with the terms. Now we are going to the critical section. So let me dust the board, make the board clean for the next section. But the next section are the critical ones. That's the recognition and the measurement. Recognition. So now let's see. Good. Recognition. Nation. So of PP. Please no shortcut. Nathan's. Great, no shortcut. Recognition of PP. Meaning how do you record PP in the books? And then on what basis do you record a PP? Basically, that is the recognition. Now, in this content, in fact, recognition in the context of financial reporting, simple means incorporating what a certain item in the financial statement. That is it, in the account. So are you going to record it? So you can replace it by what? Recording. So recognition can also be termed as recording of what? Transactions and events in a books. So when you say recognition of PP, then how do you record PP in the books? Or on what basis? All of the elements that we saw under the conceptual framework, we said that they are recorded based on what? Certain conditions. So certain conditions need to be there before they can record what? Before they can record PPE. So we call it recognition criteria of what? PPE. Recognition criteria. So in this case, PPEs are recorded as non-current assets. They are recorded as what? Non-current asset based on the following condition. So PPE are recorded as non-current asset based on the following condition. The only two conditions. Condition number one, condition number two. These two conditions, all of them must be there at the same time. So condition number one, it is probable that future economic benefits. So it is probable, now it is probable. It is probable that future economic benefits, economic benefits associated with, wow, the assets will flow to the entity, will flow to the entity. So that's the first condition. So it's probable that future economic benefits associated with the asset will flow to the entity. That's the condition number one. So before you record PP in the books, make sure that this PP, this building, it will produce a direct revenue or a direct receipt. So if you have a building or asset here, so we are the company. So, and then this asset will, the benefit will flow to different person. Then this entity or this person have the accounting right to record it. You have an asset. The owner is here. Good. This is the owner of the asset, but this is the user. B is the one using the asset. B is the one controlling the asset. So the economic benefit is flowing. You can see that in fact he will enjoy the asset too. Yes, even if you are the owner. Let's assume that let's cite a critical example. Assume that God has blessed you. Yes, to acquire one of these expensive cars. Expensive cars. Good. Expensive. Oh. Yes. The Bugatti and Co. You know them. Yes. And now, unfortunately for you, don't know how to drive. So you have a driver that moves you around. Now tell the truth. Between the owner of this vehicle and the driver, who will enjoy the benefits? Who will like fill the car? Is the one behind the wheel, right? Yeah, is the one behind the wheel. Good. So all what we are saying is this: in accounting, the one who controls the assets, B, control controls the assets. So where the control is, the one who controls the assets, not the one who owns the assets, the ownership. How we get it? Good. So B will record it in the book, not the owner. Why? because the benefit moves to B. So wherever the benefit moves to, it must be there. Good. So that is it. Now let's go to condition number 2, or first criteria. We call it recognition criteria. So criteria number 1. So number 2 is that the cost of the asset can be measured reliably. I like that term. Oh. The cost of the asset. So the cost of the asset, the cost of the asset can be measured reliably. Yes, you can determine the value of this asset accurately. So sister, thank you. Brother, thank you. Asset should not be in the books. And then some of the self-constructed assets. So each of them, we have a critical point. So I'll pick each of the conditions. Please, these conditions are very important. You are going to meet this condition 2 times. 2 to 3 times. And then we are done. So this condition. And then anytime the examiner asks you, can they record this asset as PP? Relax. These 2 conditions must be there before they can record words. Any asset as PP. Good. First of all, it must qualify to be a PP, that is tangible asset that you are not going to sell. Good. 2, the benefit will move directly to us. So the example that I said, where we lease out assets, we cease to control that asset. So that asset must not be recorded in our book. So there are 2 companies, company A and company B. He's the owner, but he has leased out asset to company what? B. So who should record it? Company B, because it's a company B that will what? Control the asset. So the first point, the line word is what? Control. Now let's come to the second point, or the second factor. That's the second criteria, the line word. Good. Here the cost must be determined easily. The cost of the assets. Now let's give example over here under this criteria, the cost. I'll give you 2 examples, then you tell me the one that you can determine the cost of that asset easily. Item number 1, purchase asset. Purchase assets. And what? B, self-constructed asset. Self what? Constructed asset. Tell me these 2 assets, which of them you can determine the cost easily, fast? This one, purchase asset, normally. Because that one you bought it from someone, so you pay. So that one you have invoices, supported documents that confirm the value. However, what about self-constructed assets? Self-constructed assets. Asset that you what? You develop it yourself. You construct it yourself. So let's consider something like the IT department join the accounting department, and then they form what you call an accounting software called the total. So they call it the total. That help them to deal with their accounting transactions. So this software, if you want to determine the cost of it, or even the IT guys join the accounting department to build a hardware component where they can store the accounting systems in, or accounting systems on. Now, this hardware component that's been constructed by the company's IT department and the accounting department, the cost of it sometimes cannot be determined reliably. Why? Because it is not easy to separate the cost of the hardware component or the cost of the asset constructed from the organization's general overheads or the organization's cost. Why? Because one, you use what? The company's resources to generate that asset. Two, the staff that constructed that asset, they're on the company's payroll. How do you get it? Good. So sometimes we find it difficult to determine the value, the actual value of the self-constructed asset. So in such case, it should not be part of the PPE. Any self-constructed asset where the cost cannot be determined reasonably, please do not include it. So here we are not saying all self-constructed assets do not qualify. No. We are talking about the one that the value cannot be determined reliably. Good. So that is it. So I'm done with the recognition. Now, some of the assets, some of the assets are in a form of major components. So how do you record that asset too? Do you record it as asset or we scrap them off? Now before that, let's distinguish between smaller items and major components or major spare parts. So we will look at it. So before we end the recognition and we start the measurement, now let's look at this. We have smaller items. We call it form under separate recognition or separate items. You know, some of the assets, before they can work together, you bring small components together before they form full assets. How do you get it? Small components together, small parts. Maybe you combine two items together to form one asset. Good. So it gives rise to two items. That's what we call smaller items. In fact, we call them tools. It must be scrapped off in the year that you purchase them, or it must be expensed in the P&L. Tools are expensed in the P&L. Good. Then we have what we call major components or spare parts. So major components, or it's also called major spare parts. Spare parts like gearbox of a vehicle, like the engine of a vehicle. Good. Now, some of the assets are complex, so their parts can be separated and called the major what components. Example is what? Aircraft. They are complex assets. Asset that parts of them, in fact, the major part have a different useful life. Can give example. Some of the assets, if you take aircraft for instance, we can have components like four. One, interior deco. So the interior deco. Two, can talk about the exterior body, the external body. External body. Good. Can also talk about the engines. The engines. Good. So this, in fact, there are more components, but I'm watching from far. Good. Because we are what? Accountants. Good. We are not engineers. So this can be termed as what? Can be recorded separately or component or partly. Why? Because the interior deco must have the cabinet, the fittings, the interior design. Maybe every 5 years they change the design, right? Every 5 years or every 2 years they change the cabinet, the fittings, the seat, the stuff in it, every 5 years they change. So that will be 5 useful years. 5 years. Then the external body, in fact, the main body, the external body can also last for, let's say, 50 years. The external body should last for 50 years. The engines, maybe every 20 years, change the engines. Every 20 years, so change the engine. So all of these have different what? Useful life. We call it components, separate components. That is it. So that is. In fact, this one, as I said, it's not every asset that you can break the component, or you can bring that asset into component. No, not every asset. It must be what? A specialized or large assets or large items, or we call it complex assets. Complex assets like ships, cruise, aircraft, cranes. Yeah, they are complex assets. And some complex buildings. Yeah, good. Now we are done. Now let's go to the. In fact, I'm going to make this one again. Yes, I will state that. Now let's go to the last section of today's game or today's version. That's the measurement. Now let's go to measurement. So now we are done with recognition. How to record what? Assets. How to record assets. So that's the recognition, or how to record PPs. Now let's go to measurement. Measurement means how to get a value. So now we know how to record them or where to record them. Now let's talk about the value. How to obtain the value is very important. In fact, almost 85% of your questions will be circulated around the value, the calculation, getting the numbers to be incorporated in the books. So measurement. Measurement simple talks about how to obtain the value. I like that. So this asset should be valued at this. This asset should be measured at this. They mean the same. Value measured. Now there are two types of measurements. We have the initial measurement. Initial what? Measurement. We also call it initial recognition. Initial what? Recognition. That's it. And then the second type is called subsequent measurement. Subsequent measurement. Now the question is this. When you acquired PP today, first time you bought the PP, what will be the value? Abigail, that's the initial measurement. How do you arrive at the value? So what do you incorporate in a book as the value of that PP initially? Which is same as what? Initial what? Recognition. Initial recognition. Good. That is it. Now, the subsequent measurement means, okay, the next reporting period, what will be the value? So you bought the asset, let's say February. You bought the asset, let's say March. Your financial year end at December. So the next December, what will be the value? So the next December, if today you bought at 50 Ghana cedis, 50 cedis, December will it still be at 50? What will be the value? So that's the subsequent measurement. We call it measurement after the initial recognition. Wow. So subsequent one. What about the subsequent one? Again, the next reporting period, and the next, and the next, and the next, and we have what we call subsequent measurement. Measurement after the first one, or after the first measurement, or measurement after the initial recognition. We are done. Now let's start. Initial measurement. Now, initial measurement of PPE is at cost. Initial PPE must be measured at what? at cost. Straightforward. It's at cost. That is it. Initially, PPE must be measured at what? At cost. Now, when you mention cost, it includes a whole lot of cost. A lot of items that goes into the cost. So we've explained cost. That cost refers to their cash or cash equivalent. So cash what? Equivalent. Equivalent or cash equivalent paid to acquired assets or their what? Fair value of consideration transfer. Consideration. You did consideration at law. So you do have a fair idea here. Good. Transferred to acquire an asset at the measurement date. So that's the cost. Just that, in fact, when I'm going to buy PPE, you incur a whole lot of cost. Not all of them qualify to be part of the cost. Only selected ones. So now let's look at the inclusion of what? Cost, or the composition of cost. So cost comprised of the following. Let me write it here at cost. And then the composition of what? Cost. Composition of cost. Or component of cost. Component of cost. Now let's see. So component of cost. Or else I can write it on top. Yes, let me write it on top. Okay. Because I'm going to write plain. Let me write it on top. So component of cost. Now, cost comprises of 3 items. It's composed of 3 items. 1, 2, 3. You are done. Only 3. Now, let's start with the first one. The first one is purchase cost. Purchase what? Cost. So, the cost that you incur when you acquire the goods. So, purchase cost. It includes the following. 1. Purchase prices of the purchase price. Purchase price is also called listed price or base price. I like that. So they've quoted for you the base price is 1,000 Ghana cedis. That's the quoted price or the listed price. Good. It also includes transportation, delivery, or handling cost. So transportation, delivery, and then what? Handling cost. It includes the purchase cost. So delivery, handling, transportation, in fact, they're in the same category. Good. Then import duties. So purchase cost alone. Import what? Import duties. But again, import duties. It includes taxes. I like this. Taxes. Please, these taxes must be what? Non-refundable taxes or irrecoverable purchase tax. Irrecoverable what? Purchase tax. Not recoverable or not refundable. Good. So these taxes are what? Non-refundable. Good. Non-refundable taxes. The issue is this. This PP you are going to classify as assets. Any tax that you pay on this good, this PP, and that tax, you are not going to recover it back or claim it. That tax must be part. But if you know that you're going to claim this tax, the VAT that you pay, that you're going to claim it because you are VAT registered entity. So VAT registered entity, you can claim the tax that you pay, the VAT that you pay. It should not be part of the what the cost of the PPE. Less what trade discount, less trade discount, trade discount, or similar rebates. Similar what rebate. I'm writing it here, right? Similar rebates. So rebates are just tax intensive or reduction in prices due to the nature of the product. Normally, if you buy educational equipment or health equipment, PPs, there are some incentive on it. You less them. You know trade discount, right? That's the bulk discount. Maybe you bought a lot of the plants. You bought 3 plants at a go. Heavy duty plant. You bought 3 or 5 or 10 or 20. In fact, you bought more than that, and then they gave you what? A trade discount, bulk discount. You less it. Please, settlement discount, ignore. We don't treat settlement discount here. It's a trade discount that we are talking about, or cash discount. Ignore cash or settlement discounts. What we are talking about here is trade discount or bulk discount. Discount given to you for what? Bulk purchases. Good. So that is it. So these are what? The purchase cost. So these are the purchase cost alone. So that's the composition of the purchase cost. Now let's move on to the next cost. The next one is the the directly attributable cost. Directly what? Attributable cost. So two directly attributable cost. So directly attributable cost. Now sometimes when you acquire this PP, you have to work on them before you can bring it to its intended use. Maybe you want it to suit a certain style, so you have to work on it. Especially if you are looking for, let's say, a particular engine, and if you search for it, you are not getting it. So you acquired a different engine, so you have to now massage this engine to suit or trade this engine to get what you want. In fact, directly attributable costs are the labor costs and the overheads that you incur on the plant or the PP before it become what usable. Good. They include the following: one, testing. Yes, testing. So one, testing. Testing also include what? Site preparation. I like that. Site what? Preparation. It also include what? Installation. Electrical installation. It also include professional fee or professional charges. So professional fees, professional fees. Example of professional fees is what? Architect, lawyer, quantity surveyors, engineers. All of these are what? Professional fee. Consultant. Some of the PPs, you're not buying them, please use consultants. Because most of them are expensive. Expensive. So if care is not taken, you may buy a waste. So consult with a professional, especially land. Land. I hope you know that acquiring land is not easy. So you have to know contact a legal team for a legal advice, and they'll charge you. It might be part of what the cost of that PPE. So this is what the the directly attributable cost. Now let's move on to the last section, or the last cost. We call it any other cost incurred necessary to bring the asset to its present condition or location. Any cost incurred necessary to bring the asset to its what? Present condition or location. So we call it any other cost incurred necessary to bring the asset to its intended use. In fact, any other cost that you will incur that will allow you to start using the asset. That's all. That's all. So here I have some stubborn examples. I'll explain why they are what a bit complex. So examples of other costs include dismantle cost, dismantle cost, or removal. The asset must be removed, or relocation of the asset. You know that this asset, it must spend, let's say, 5 years at this factory. We have 3 factories in the country, and then you don't have money to buy plant for all this factory. So you have only one plant which is been moving. So factory A, factory B, factory C. But the relocation cost will be incurred. Good. So I have to remove, dismantle the asset. Either I have to destroy it or relocate it. Good. So site restoration cost, site what? Restoration. So restoration, we have site preparation, and site have to restore the site back to its initial position. Let us know it was a plant. You prepare the site by what? Casting some concrete heavy to hold this heavy duty plant firmly. Other than that, one day you wake up and then the plant has what? In fact, break the wall and then extend to the next premises. Good, because of the vibration. Even sometimes some organization give some permanent structure for the plant to to prevent the asset from where? Environmental effects. Yeah, environmental effects. Maybe rain or sand, direct sun rays on that asset. So they build so nice room for the plant. Good. Or a structure, something, a shade, a structure to just prevent the environmental effects on the assets. Good. So when they are done, maybe the assets have 10 years. At the end of the asset life, you have to transfer the asset from there, or relocate the asset, or take the assets and then destroy the assets. So that structure too must also be what? Restored back to its initial position, or the land or the site must be restored back. So that's the site restoration cost. We can also have decontamination cost. Decontamination cost, or environmental pollution. Maybe this particular asset will cause some damage to the environment, but the law instructs you that at the end of the asset life, make sure that you rectify all the damage caused by this asset. It can be noise, it can be smoke, it can be harmful gases that you have what emit to the atmosphere, or sewage. Good. So that is great. Now, what makes this cost special or complex is that they are costs that you incur them in future. All of this, you incur them at future dates, not now, not when you bought the asset. It's when you're going to remove the asset from the site that you have to incur such cost. So they are so special. So be with me after getting to the last or the end of this video. I will demonstrate how you could what? treat such costs in the books. So kindly be with me. The last chapter of this is how to look at the dismantle cost. And please, I will I will link a certain video at the comment section or the video description section. When you tap on it, it will send you straight to a lecture video solely on dismantle cost, how to treat dismantle cost, and you'll be fine. Good. Now let's see. So now these are the components of cost of PPE. Now, what are the exclusion? Some of the costs, when you incur them, exclude, they should not be part, they shouldn't form part of what? The component. So exclusion from the cost. So exclusion. So the following costs, even if you incur them on the asset, they shouldn't form part of what? The cost of the asset. They shouldn't form part of the cost of the asset. Item number 1, initial operating losses should not form part. Initial what? Operating losses. Now, for some of the assets, they will tell you that the asset should be on for 48 hours before you can get the optimum capacity. So 2 days. So within that 2 days period, in fact, the performance of the asset will not be normal. So it may cause some certain errors, certain losses. Please, that loss or such losses should not be part of what? The cost of the PPE. Instead, expense them. So all these costs must be expensed in a P&L. Must be expensed in a P&L. Good. This cost must be capitalized. It must be form part of the cost of the asset, but the exclusion must be expensed in a P&L, or it must be written off in a P&L if you incur them, but it must not be what? Capitalized or add to the cost of the asset. 2, admin or general expenses or general overheads. Admin or general overheads. Don't say that, oh, apportion some of the admin overhead to that of that plant. No. Admin and general overheads are operating expenses. It must be expense. This file, it must go to where? Operating expenses. For those of you who are aware of operating expenses, take note. Then 3. The third one is staff training cost. Staff training cost. Let me cite an example. Let's assume that you've acquired a complex PP, complex asset. Maybe which asset in Ghana here? Now, which asset is more complex? Well, a complex asset that the employees currently, none of them can operate that asset. Wow. So we decided to train the employees, in fact, internal and external, sometimes outside the country. And it costs you so much for training such employees. Now the question is, are you going to add such amount to the cost of the PPE or cost of that complex asset, the staff training cost? You are saying yes, it should be part. Now the question is, the staff training cost, will it make make the asset ready for use, or rather make the staff ready to use the asset? So the staff training cost will only make the staff ready to use the asset, not the asset. So let's assume that you've trained them heavily, severely, and they finish that the asset is not working. What have you done? Cost 90. So it means that the staff training course will only make the staff ready, not the assets. And here, what are you calculating? We are calculating what? Cost of asset, not cost of what? Staff. Good. So staff training cost should not be part of what. However, one of the costs say testing. If someone labor cost, someone conducted a test for you, you have to pay the person, and that one should form part. But training cost should not form part. So these are the few items when you incur them, they should not be part of what the cost. Then I'll talk about one more. That is the startup and similar pre-production cost. Yeah, should not also be part. Startup or pre-production cost. Pre-production cost, I'll give you a critical example. So let me add the fourth one to it. Fourth one is what? Startup or pre-production cost. I normally call it pre-production cost. Pre-production cost. Pre-production cost. Oh, it's not coming. Sorry. I'm fine. Okay. Now, pre-production cost. Now let's assume that you went to the market, you bought a plant, a production plant. When you're coming, you bought fuel, bought oil, you bought raw materials. Maybe you bought a fufu pounding machine. Fufu pounding what? Machine. And you are a restaurant. So this PP that you brought to come and then probably pound the fufu for you or grind the fufu for you. When you're coming, you bought oil, you bought some lubricant, you bought in fact you bought cassava, you bought plantain, so that when you come, you use it to test the machine, or you like when you start producing the first product, you will get them. Unlike you bought the machine first and later on go to the market, go and buy the stuff. Maybe you are considering the cost and the availability. So once normally it happens because normally when you buy some of the equipment for the first time, when you're buying them for the first time, you make sure that all what you are going to use to produce those ingredients or those materials are there. So you bought raw materials in addition and some fuel. Don't tell us that those raw materials should form part of the cost of the machine, full pounding machine. Not at all. They are pre-production cost and they should not form part of what? The cost of the equipment. So anywhere you see these items, they should not form part of what? The cost of the PP. Instead, they should be what? Expense the P&L operating cost. We are done. Now let me walk you through the last aspect for today's lecture. That will be the dismantle cost. How to treat dismantle cost. That's the end of today's section. It's a very topical item. So, like I said, I will link a full video on dismantle cost at the video description section and in the comment box too, so that you will familiar yourself. So let's assume that you bought an asset, the purchase cost. But please, this is the teaching session, so here we don't solve questions. Kindly look for or follow the next video. It will guide on question solving. That one, practical questions together with what past exam papers, and then we solve them. So the purchase cost of a certain machine, let's say plant. Purchase cost of a plant is so Abiola Limited recently acquired an assembly plant. So bought an assembly plant. So bought a plant with the following details. So purchase price is at $50,000. Ghana cedis. Wow. So that's the price of the plant. 50,000 cedis. Oh, sorry. Income. Abiola Limited. Abiola Limited. Now this plant will be dismantled at the end of the asset useful life, which is 5 years. So in 5 years' time, the plant will be dismantled at a cost of, in 5 years' time, the plant will be dismantled at a cost of 10,000 cedis. Wow. 10,000 cedis. Full stop. Abiola's cost of capital, they have to give you the cost of capital of the company. Cost of capital is, let us assume to be 10%. Yes, I like 10. So, full stop. Kindly take a screenshot of it. I'll take them off. I'll summarize it and then take it off. So that's the question. Avia Limited bought a plant, purchase price 50,000, 5 years time, plant will be dismantled at a cost of 10,000, cost of capital is 10%. We are done. So illustration purposes, we are saying that this plant, at the end of the 5th year, the plant has been removed. This year 1 or year 0. Now we bought it at 50,000. Just that we have to incur another cost again at the end of the 5th year, which is 10,000 cedis. So the question is, how do you treat this dismantle cost, this 10,000? That's all. So let me give you the procedure or the steps first. Then I'll use this illustration or this as what question. So wait, just give me 3 minutes, 3 to 5 minutes to wrap up. Okay. Then we have the asset section. So with the dismantle cost, accounting treatment of dismantle cost. So accounting treatment of dismantle cost, that will be the topic. Accounting treatment of what? Dismantle cost. We have 2 sections. Dismantle cost have 2 sections. Why? Because it is a cost that you incur in future, not today. So it's like a form of liability. It's a provision. Good. So it's an asset at the same time provision. So let's look at the asset section. So for asset section 1, add the present value, add the PV of the dismantle cost to the cost of the asset, to the cost of what? The asset. So that's the asset section. That's the first. What do? Add the present value. Why? So find the present value. The cost of capital is 10%. What's the 10,000 payable in 5 years' time? What's the present value? Add it to it. You are done. That's all. That's the asset section. The liability section. Go to the liability section. Liability section have 2 steps. Now, the same PV, the same amount that you added to that of the plant will be the same for the open balance of the liability, because that will be the provision at the start. So 1, find the liability at the start of the year. So find the liability at start of the year, the first year, which is nothing by the same as the answer in 1. This one. Okay, the answer in, okay, let's make it 2. The answer in 1. So this is the 2. Third step, Unwind the discount. Wow, what a term. Unwind what? The discount. Unwind the discount. Unwind the discount. Good. The third one is unwind. Unwind the discount. Let me explain. Discount. To arrive at what? The closing balance, which will be shown in the financial statement as non-current liability. Unwind the discount and then add it to the liability at the start to arrive at what? Liability at end. To arrive at liability at end. To arrive at liability at end. To arrive at liability at end, which will be shown in what? The financial statement as non-current liability. As non-current liability. Good. So that is it. Now let me explain the one of the discount. After you find the present value, what can we do so that we'll be increasing it? So at the end of the fifth year, we have our 10,000 there. I will do the illustration when I'm solving it. So we are done with the steps in solving. Now let's solve this question. So first, I'll do the asset section. So I'll calculate the cost of the assets. That's the first thing that I'll do. So solution, cost of the asset. So to get the cost of the asset, so workings, one, cost of the asset, cost of the plant. So first, purchase price, which is 50,000 Ghana cedis. Now tell the examiner that PV of what? Dismantle cost. So I have to find the present value. To find the present value, now we can use the present value of what? Of the future value. So it will be the PV, sorry. So the PV, in fact, the formula will be future value, that's the dismantle cost, 1 plus R. R is the cost of capital to the power N. N will be what? The number of what years when exactly you are going to pay. Now here, be careful. Not always that they are going to pay this amount at the end of the asset life. Sometimes the asset will be dismantled 2 years after the life or a year. So when they state that, if they say 2 years after the life, then it will be 7. So I will pay this fee or this 10,000 in 7 years time. So the end will become what? 7. Good. So this is the formula for finding the present value. The future value is the dismantle cost that you are going to incur. So over here, open my bracket to nicely. F future value 10,000. I'll divide it by 1. What's the cost of capital? 10%. That's the cost of capital, which is what? 10%. Good. So 10% will be 0.1 to the power of 5. So you pick the calculator, then you type 10,000 divided by this. 10,000 divided by 1.1 to the power 5. So that will give us wait. So that will give us 6,000. Oh, sorry. 6,209 Ghana cedis. Good. So we put all of them together. So in short, the total cost of the asset now be what? 56,209. That is the answer. However, depreciation must be based on this value. You have to depreciate this value. That is it. At the same time, this figure is a liability. Good. So that is it. So that's the first section. How we get that? So first, to get the asset value, find the present value of the dismantle cost, and then key it in, add it to the cost of the asset. Now, the dismantle cost is a stubborn cost. Why? It's a cost that you incur in future, but it must be in today's cost or today's book. That makes it a bit stubborn. Good. So that is it. Great. Now let's continue the game. Now I'm going to do the liability section for you. So be with me. So I'll dust the board again and then do the liability section because that one is a bit complex. So liability section. Liability section. Liability section. Liability section. So the liability component. Good. So liability components. First, I'll go by year. So let us know in the first year, year one, what happened. So year one, find the open balance of the liability at the start, and it's nothing by the present value of the dismantle cost at that time. So the open balance of the liability is the present value of the liability at the start of the year. So it becomes the same liability or liability at the start. Good. For the year one, you have the 6,209. So the same dismantle cost that we have added to the cost of the asset, the same value must be a liability. And start. Then what do? Here we say unwind the discount. Let me explain this term. Unwinding of what? Discount. Unwinding of discount. It's a technical term. Good. Now, the future value was 10,000. The value in 5 years' time is 10,000, but the value today was 6,209 Ghana cedis. We discounted it? Wow! So it means that we brought it into today's term by doing what? Discounted it. Now the question is this: if we state it as 6,000 as fixed, at the end of the fifth year, we may not be able to get the 10,000. So what do we do? So what we must do is this: we discounted this in today's term. So what can we do so that at the end of the fifth year, this 6,000 automatically becomes 10,000? Okay, then we have to unwind the discount. So it means that every year, this 6,000 must be what? Increase. So here it's year 0 now, today's value. So 1 year later, let us increase it. Another year, year 2, let us increase it. Year 3, let's do the same. Year 4, let's do the same. So the year 5, the value will be what? 10,000. So this procedure is called unwind of discount, but it's too technical. Don't worry. Just tell the examiner that it's also called increase in provision, because this one is a provision. So increase it so that at the end of the fifth year, you get 10,000. How do you do that? How do you increase it? Don't worry. In fact, you discounted it. So the reverse of discount is called on discount, right? Have you seen it's done nice? So that's why we don't call it that, on discount. You discounted it to get this. So now remove the discount. If you remove the discount, you get this, the future value. Yes, because opposite of discounted figure or present value is what? Future value. So, in short, we have to be increasing it so that in future it will be the 10,000 we have there. So that's why they tell me. So the on discount will not be nice. So remove the discount and then they call it what? Unwinding of discount. Unwind. So So we are going backwards like this. Formerly we were like this. Good. We have discounted it. So now unwind, 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 unwind. That's great. So just call it increase in provision. Do it year by year. So at the end of the year, we get the 10,000. That's great. Now let's perform it. So now you understand the unwind of a discount. So even if I use it here, you won't be confused. Wait, because I wanted to use what? Increase in provision. Increase in provision. But the term is unwind of discount. You can also call it increase in provision. So on winding of discount, how do you calculate it? Just pick the present value or the opening balance, this value, and then multiply it by what? The cost of capital. So it have to be 6209 times 10%. That will give us 621. We're done. So that becomes the closing balance or the liability at the end of the first year. So the closing balance will be 6830. How do you get it? Then you relax. You relax for a while. You come back again. Year two. Have you seen? Year by year analysis. Opening balance for year two will be what? 6830. Still, unwind the discount. Increase it again. Unwinding of discount. Still, here you don't use this six figure, no. Use the opening balance. The liability at the start of that year, year two, at the start of year two is what? 6830 times 10%. You get what? 683. You put it together, then you get a liability at the end of what? Year two. So closing balance. Closing balance at the end of year two. Then you get something like, if you put the two together, if you put these two together, what do you get? So now let's see. So that would be 6830 plus 683. So that's 7573. So 7573. And this procedure will be continued. Or you follow these steps until you get to year 5, where the closing balance will be what? 10,000. Great. So that is it. I hope you get it. Now let's see. What's the treatment? So at the end of the year one, when you're preparing your financial statement, so let me prepare the financial statement here for you nicely for you to see how we are going to record the items. What we did is the workings. So for financial statement, the name of the company is what? Abiola, right? So Abiola Limited. Abiola Limited. Good. So the P&L, what to go to the P&L, the profit and loss statement. First, don't forget your depreciation. Year one, year two, up to what? Year 5. How do you get it? Year one, year two, up to year 5. Let's see. Good. Up to year 5. So your currency depreciation will be what? That said we had 56,000. We had 56,209 divided by 5. That would be depreciation, right? To run through all of them. So let me do it. So 56,209 divided by 5. So I'm getting 11,241 or 242. So 11,242. You continue like that, you got the same figure in. Then the unwind of the discount, it's a finance cost. Why are you? This figure, these figures are what? Finance cost. So it must go to finance cost for that year. It must go to finance cost. Come and record finance cost here. So under the finance cost, you bring what you call unwinding of what? Discount. Unwinding of discount. So for the year one, our record was 621. For year one, 621. For year two, our record was 683. So 683 in that order. So that's how the entries will be. Good. In the P&L. We are done with the P&L. Now let's go to the financial position, the balance sheet. In the balance sheet, the same show. First, the asset, you find the carrying amount of the asset, which is common. You subtract the accumulated depreciation from the cost. The cost is 56,209. Then you are done. Then when you come to the liability section, all the balance carry down. The closing balances, this figure, and then this figure, continue like that. They will go to where? Non-current liability. So these are non-current liabilities. You are done. Except the fourth year. In the fourth year, because you are going to pay in the fifth year, you step him down towards current liability. And that's the end of the game. So thank you very much for coming. Kindly subscribe to the channel if you have not done that. And kindly please follow us when we are solving the question. No jumping. So follow us. We come to the question solving stage. And please, the next section will take it from the subsequent measurement. So now we know up to what the initial measurement. So this entire video, take it from the scope, objective, up to the initial measurement. So this is the initial measurement of what? PPE. Good. So the next video will pick it from where? Subsequent measurement and the question solving stage. Thank you very much for watching. Kindly share. Then kindly share the video, the link, and then subscribe to the page. Yes. Target professional consults. See you once again.